Have you ever opened a brokerage app and felt that paralysis? 700 funds blinking at you. 3 hot picks shouting at you. And the only honest answer in the room, long-term investing for beginners, is not a stock-picking game. Never gets a single notification. 3 rules end the paralysis. They are not the rules the app is selling. They are the rules John Bogle named in plain English 50 years ago. And the data still confirms every one. So let me ask you something honest. Have you stared at that list, scrolled until your thumb went numb, and then closed the app without buying anything? Or worse, bought the loudest one and watched it slide? You did not need a sharper pick. You needed 3 rules in the right order. Here is the thing nobody tells you when you sign up. The brokerage app is not built to teach you how wealth compounds. It is built to keep you transacting. Every red number, every push notification, every shiny new fund, that is friction dressed up as activity. And activity, in investing, is the most expensive habit there is. The calm investor learns this early. Wealth does not compound on the days you trade. Wealth compounds on the years you do not. The Stoics would have called it the difference between what you control and what you do not. You do not control the next quarter. You do not control which fund gets heat next week. You control 3 things: what you own, how long you own it, and what it costs you to own it. That is the shape of the code. Stay with me to the 3rd rule. Most beginners skip it, and it quietly decides how much of the market's return actually reaches your account. The first 2 rules tell you what to own and how long to hold it. The 3rd tells you what to stop bleeding while you do. The framework is called the compounding code. 3 rules, climbed in order, and the order matters. Lowest cost first. The names, in plain English, are these. Buy the haystack. Time in, not timing. Cost is drag. That is the whole thing. 3 sentences a calm investor can hold in one hand for 40 years. Each rule traces back to a primary source. Each one is reconfirmed by 2024 data, not by a guru on the internet. And each rule asks for less from you than the one before it. Let me walk you through them, one at a time, in order. Buy the haystack. Go back to the screen with the 700 funds for a moment. The whole reason you froze is that the app is asking you the wrong question. It is asking, which one will win? The honest answer is, almost none of us know, and the people paid full-time to know do not know either. Most actively managed funds, run by full-time professionals with research teams and Bloomberg terminals, do not beat the index they are trying to beat. That is not opinion. That is the data, year after year, decade after decade. The S&P SPIVA 2024 scorecard found that over the previous 15 years, 88% of large-cap active funds underperformed the S&P 500. 88%. The professionals lost to the simple index nearly 9 times out of 10. And the small fraction that did beat it, there is no reliable way to know which ones in advance. The persistence data shows past winners do not predict future winners. The pattern washes out. So Bogle, who founded Vanguard, gave us the only sentence you need. John Bogle, who founded Vanguard, wrote in The Little Book of Common Sense Investing, the 2017 10th anniversary edition published by Wiley, quote, "Don't look for the needle in the haystack, just buy the haystack." He meant it literally. Instead of guessing which company will win, you own all of them through one fund, a total market or S&P 500 index fund. The big winners of the next decade, whatever they turn out to be, are already inside it. The losers are too, but their weight is small. And the winners carry the field. You stop trying to guess. You stop trying to be the smartest person at the screen. You just own the field. One fund. The whole market. The rest of your life. That is the haystack. Time in, not timing. The temptation here sounds reasonable. You tell yourself, I will get in when the market settles. I will wait for the dip. I will buy back when it feels safe. The cost of that sentence is enormous, and it is borne almost entirely by the people who say it. Here is the data that ends the debate. J.P. Morgan's 2024 Guide to Retirement studied a 20-year stretch from 2004 to 2024. An investor who stayed fully invested in the S&P 500 for the entire period earned roughly double what an investor earned who missed just the 10 best market days. 10 days out of about 5,000 trading days. Missing 10 cut the return roughly in half. And here's the part the timing crowd never tells you. Most of those 10 best days happened within 2 weeks of the worst days. The market bounces hardest right after it falls hardest. So the people whose instincts feel most right in the moment, sell now, get out, wait for clarity, are the people who lock in the loss and then miss the rebound. They sell at the bottom. They buy back higher. Their certainty costs them. Benjamin Graham wrote in The Intelligent Investor, Jason Zweig's revised edition, Harper Business, 2006, that the investor's chief problem, even his worst enemy, is likely to be himself. He wrote that line in 1949. Zweig reconfirmed it in 2006. J.P. Morgan reconfirmed it in 2024. The rule does not change. So the calm move is not a smarter entry. The calm move is to set your contributions to invest automatically, every paycheck, every month, no decisions in the moment, and then leave them. Time in the market, not timing the market. The best days hide next to the worst, so the only winning entry is to stay. Cost is drag. This is the rule most beginners skip, and it is the one that quietly decides how much of the market's return ever reaches your account. There are two cost layers. The first is the explicit fee on the fund itself. The second is the cost of your own behavior. Start with the fee. Morningstar's 2024 U.S. Fund Fee Study reported the asset-weighted average mutual fund expense ratio was 36 basis points in 2023, the lowest figure on record. That sounds small. On a 30-year compounding curve, it is not. Every basis point you pay comes off the top of your return before the market ever touches your money. Now layer the second cost on top. Morningstar's Mind the Gap 2024 study tracked actual investor behavior versus the funds those investors held. The average investor underperforms their own funds by roughly 1.7% annually, not because the funds did badly, but because the investors bought after a hot quarter and sold after a bad one. Mistimed flows. Money pulled at the bottom and added at the top. Quietly, year after year, that gap subtracts. Stack the explicit fee and the behavior gap together, and you can lose close to 2% every year, for nothing. 2% does not sound dramatic in any single year. Compounded over 30 years on the same paychecks, it is roughly half your final balance. Bogle wrote it in the same book. In investing, you get what you don't pay for. Cost is the one variable in this whole game that you control completely. You cannot pick the winning stock. You cannot time the dip. But you can pick a low-cost index fund, automate the contributions, and stop trading. That alone, that one move, has already raised your return. Cost is drag. Lower it, and you have already won the part of the game that is yours. Now look at what just happened. The screen that paralyzed you, 700 funds, 3 hot picks, a dozen flashing tickers, collapsed into 3 sentences. Not 500 funds. Not a hot pick. 3 rules. You do not need to pick the stock. You need to climb the code. Buffett did this. Bogle did this. Graham did this. None of them found the next needle. They bought the haystack, stayed in time, and kept costs low, and the math compounded around them while everyone else was busy reacting to the news. So if you have been telling yourself you are bad at investing, hear this clearly. You are not bad at investing. You were never taught the 3 rules that come first. Now you have them. Say them out loud. You do not need to pick the stock. You need to climb the code. That is the compounding code. Rule 1. Buy the haystack. Own the whole market. not the 700 guesses inside it. 88% of the professionals could not beat the index, and there is no reliable way to know in advance which ones will. So you stop guessing. Rule 2. Time in, not timing. The best days hide next to the worst, so the only winning entry is to stay. JP Morgan's 2024 data made that final. Rule 3. Cost is drag, the one variable you control completely, and the one most beginners ignore. Lower it, and you have already raised your return. 3 rules. In order. Lowest cost first. Buy the haystack. Time in, not timing. Cost is drag. That is the whole code. Here is the one thing to do in the next 24 hours. Open the brokerage statement or the 401k screen you have been avoiding. Yes, that one. Write 3 lines on a single page. Line 1. Are you in the haystack, a total market or S&P 500 index fund? Or are you in single bets and sector picks? Be honest with what you actually own, not what you meant to own. Line 2. Is your money set to invest automatically, every paycheck, no decisions in the moment, or are you still timing entries by mood? Line 3. What is the expense ratio, in basis points, on every fund you hold? Most apps display it in the fund details. 3 lines. 1 page. Tonight, before sleep. Tomorrow morning, that page will say something about your portfolio the brokerage app never did. If this gave you one rule you can use tomorrow, hit the like button. It tells the algorithm a calm investor video earned a calm investor viewer, and that quietly puts it in front of one more first-time investor who needed it tonight. Share it with the friend who keeps asking you which stock to buy. They need this more than another hot tip, and the page they write tonight will outwork any pick you could have given them. And subscribe for the Calm Investor Playbook that turns volatility into compounding. We do not chase headlines here. We do not sell hot picks. We climb the code. 1 rule at a time, in order. Lowest cost first. Calm investors. Build wealth with patience, not panic.